What if I told you that the greatest danger to your trading account isn't the chart in front of you, the news release, or even the algorithmic machines you believe are moving the market against you? The real danger sits inside your head, in the part of your mind that hungers for action, recognition, and the thrill of being right. Robert Shiller calls it irrational exuberance, and if you don't confront it directly, you'll keep making the same mistakes. Buying too high, holding too long, and panicking when the inevitable reversal comes. You've felt it before, the euphoric rush when a stock you bought rockets upward, the sensation that you've uncovered the secret to the market. Suddenly, every trade feels like confirmation of your brilliance. Your account grows, your confidence swells, and you start ignoring risk because you're in tune with the market. But have you ever stopped and asked, is this skill or is this just euphoria disguised as wisdom? Shiller begins by dismantling the myth that markets are purely rational machines. He shows you that prices often drift far above what fundamentals can justify. The reason isn't hidden information or complex math, it's the psychology of crowds. When traders see others making money, when headlines scream new economy or unstoppable growth, you start believing that this time is different. But that phrase, this time is different, is the anthem of every bubble in history. Think about the dot-com boom. Investors piled into internet stocks, many with no profits and no business model, because everyone else was doing it. You weren't analyzing, you were following. And when the bubble burst in 2000, trillions of dollars evaporated. Yet in that moment of euphoria, no one thought they were being reckless. They thought they were seizing opportunity. Shiller's insight is that exuberance blinds you not because you're stupid, but because your brain is wired to crave stories of endless growth. Here's the trap. Markets don't need you to be right. They need you to be disciplined. But discipline feels boring compared to the dopamine rush of chasing momentum. That's why you overtrade after a winning streak. That's why you double your size on the next setup because the last one worked. You tell yourself you're being rational, but you're actually feeding the beast of exuberance. Shiller's warning echoes Mark Douglas's trading in the zone. Consistency comes from thinking in probabilities, not certainties. You can't own the market. You can only manage your exposure. The moment you let euphoria convince you otherwise, you've already lost control. Jared Tendler would call it an emotional hijacking. Your logic has left the room, replaced by excitement masquerading as confidence. So, how do you break free? You start by recognizing the symptoms. Do you ever catch yourself looking at your P&L more than your charts? Do you feel restless when you're out of a trade, itching to get back in so you don't miss out? That's not rational strategy. That's exuberance whispering in your ear. And if you keep listening, you'll end up chasing shadows, not opportunities. Shiller forces you to confront the truth. Exuberance isn't rare. It's constant. It exists in bull markets when everything rises, but it also lurks in bear markets when fear turns every dip into a freefall in your imagination. Both greed and panic are twins of the same irrationality. You're not immune because you know better. Knowledge doesn't stop emotion. Discipline does. Here's the uncomfortable part. Sometimes you profit because of exuberance, not despite it. Think of meme stocks, crypto surges, or parabolic rallies. If you jumped in early, you look like a genius. But Shiller reminds you that luck during euphoria is deceptive. It convinces you the madness is sustainable, and you double down. That's how small wins turn into catastrophic losses. You didn't have an edge. You were riding a wave of collective illusion. Take a moment and ask yourself, when was the last time I made a trade because of fear of missing out, not because my plan told me to? If the answer is last week, then you're not trading. You're gambling with a false sense of control. And that's the essence of Shiller's message. The market's greatest trick is convincing you that irrational behavior is rational. You need to decide right now whether you want to be part of the crowd or part of the minority that survives when the crowd gets crushed. The crowd will always scream louder, but survival comes from ignoring the noise and staying anchored to process. That's why Steve Cohen drilled into his traders the need for journaling, review, and constant reflection. Because memory is short, but exuberance is persistent. Shiller isn't telling you to avoid opportunity. He's telling you to redefine opportunity. True opportunity isn't about catching the biggest move. It's about being prepared when the market offers setups that align with your edge. And if you can internalize that, you'll realize that your real enemy isn't the next crash. It's the part of you that can't resist the lure of market euphoria. So as you step into this journey through irrational exuberance, you'll be asked to face yourself. Not the version of you that tweets charts or shares wins, but the version that stares at the screen late at night, hoping tomorrow's market validates today's risky decision. That's where bubbles are born, in the quiet moments where discipline surrenders to excitement. If you've ever broken your trading plan because of one green candle, if you've ever held a loser because it has to bounce, then this lesson is already about you. And if you ignore it, you'll keep feeding the cycle Shiller describes: euphoria, blindness, collapse. But if you face it, if you're willing to challenge your own psychology, then you'll finally understand what every bubble is really teaching. Your edge isn't in the market, it's in your mindset. What if I told you the true lesson of irrational exuberance isn't just about spotting bubbles, it's about transforming how you think as a trader? Shiller's work doesn't hand you a new indicator or a magic entry signal. It gives you something far more valuable, a framework to build a rational trading mindset in a world dominated by irrational behavior. And if you can internalize that, you'll stop being the prey of markets and start trading with the discipline of a professional. The rational mindset begins with humility. You accept that you cannot predict the market with certainty. Shiller proves that prices often disconnect from fundamentals, driven by stories, herd behavior, and feedback loops. If you cling to prediction, you'll be crushed when the crowd veers off script. But if you think in probabilities, as Mark Douglas insists, you align with reality. You stop asking, will this trade win? And start asking, how do I manage this trade if it doesn't? That shift is everything. The rational mindset also demands self-awareness. You are not separate from the crowd. You are vulnerable to the same emotional contagion. Shiller shows you how narratives seep into judgment, how confidence inflates when others are euphoric, and how fear multiplies during crashes. If you don't recognize those forces in yourself, you'll keep telling yourself you're trading objectively while actually chasing stories. Jared Tendler calls this illusion unconscious incompetence. You think you're in control, but your emotions are driving the wheel. Awareness is how you break free. Another pillar is discipline. Steve Cohen hammered this into his traders. The key is not making money, it's keeping it. Shiller's bubbles remind you why. Exuberance makes you reckless, collapses make you desperate, and without discipline, both destroy you. Journaling, review, strict risk management, these aren't optional. They are the armor that protects you from your own impulses. Every bubble survivor has one thing in common. They respected discipline when others abandoned it. But here's the deeper insight. A rational mindset isn't about avoiding all risk. It's about embracing the right kind of risk. Shiller never argues that traders should sit on the sidelines forever. He argues that traders must distinguish between opportunity and mania, between setups grounded in process and setups fueled by hysteria. You don't withdraw from markets, you engage with them wisely. That means you ride trends when they align with your edge, but step aside when they morph into bubbles. You're not trying to outsmart the crowd, you're trying to outlast it. And don't miss this. Shiller connects directly with other trading psychology masters. Where Douglas teaches probabilities, Shiller shows you why probabilities are violated when emotions dominate. Where Tendler explains tilt, Shiller maps the narratives that trigger it. Where Bellafiore emphasizes journaling and review, Shiller gives you the context, why memory fails, why stories cloud clarity, and why reflection is your antidote to contagion. Together, they create a unified framework. Survive by mastering your psychology, not the markets. So what does this mean for you right now in your trading journey? It means you stop searching for certainty in indicators or gurus. You start searching for discipline in yourself. You accept that exuberance will always exist, sometimes in bull markets, sometimes in bear markets, sometimes even inside your own account. Your job isn't to eliminate it, it's to resist it, manage it, and use it as a signal that the crowd has lost control. Ask yourself, which part of irrational exuberance should you read first? Start with Shiller's exploration of historical bubbles. Study them until you see yourself in them. Because once you recognize that your impulses mirror the mistakes of traders across centuries, you'll stop believing this time is different. Then move to his analysis of narratives and feedback loops. Train your eye to spot them in real time. And finally, internalize his warnings about collapse, not to scare you, but to prepare you. That preparation will give you the confidence to stay disciplined when others lose their heads. Because in the end, Shiller isn't just describing markets, he's describing you. He's holding up a mirror and asking, will you be another casualty of irrational exuberance? Or will you be the rare trader who survives by mastering your mind? The answer doesn't lie in the charts. It lies in whether you're willing to confront your own psychology, to build a rational mindset in an irrational world. So the next time you're tempted to chase, remember this: exuberance always ends. Stories always collapse. The crowd always loses. And the only traders who endure are the ones who respect discipline more than they crave belonging. That's the rational trading mindset. That's your edge. So here you are at the end of Shiller's Irrational Exuberance. After walking through the lure of euphoria, the repetition of historical bubbles, the contagion of stories, the trap of overconfidence, the battle between valuations and emotions, the mechanics of feedback loops, the inevitability of collapse, the devastating impact on real economies, and the tools to resist mania, you're left with one truth: survival in trading isn't about predicting the market. It's about mastering yourself. Shiller's warning is clear. Every bubble feels new, every story feels unique, every rally feels safe, until it isn't. And unless you recognize that psychology drives markets more than numbers in the short term, you'll keep falling into the same traps. But if you respect risk, study history, and build discipline, you can step aside when the crowd loses its mind and position yourself when opportunity returns. Your next step isn't to hunt for the perfect trade. It's to journal your reasoning, test your patience, and remind yourself that your edge isn't in chasing hype, it's in resisting it. Because the market doesn't reward the loudest voices or the boldest bets. It rewards the trader who can stay rational in a world addicted to irrationality. If this breakdown helped you, hit like, drop a comment with your biggest takeaway, and subscribe for more deep dives into trading psychology. Your discipline begins now. Don't wait for the next bubble to remind you. You've heard the phrase, history doesn't repeat itself, but it rhymes. When it comes to financial markets, the rhyme is deafening. If you look closely, you'll see that every bubble carries the same rhythm: euphoria, expansion, mania, denial, and collapse. Robert Shiller doesn't just describe this cycle. He shows you how it has echoed across centuries, from tulip mania in the 1600s to the dot-com crash and the housing meltdown. And here's the hard truth. Unless you study these patterns and internalize their warnings, you're destined to repeat them with your own account. Think about the great crash of 1929. At the height of the Roaring Twenties, people believed prosperity had no limits. Stock prices soared, and investors borrowed heavily to chase the gains. It wasn't analysis driving decisions. It was the intoxicating belief that the good times would last forever. Doesn't that sound eerily familiar? The same euphoria drove traders into internet stocks in the 1990s and condos in the mid-2000s. Each time, people declared, this time is different, but it never was. Shiller forces you to confront a chilling realization. Bubbles don't emerge because traders are dumb. They emerge because human psychology doesn't change. You crave certainty, security, and the thrill of belonging. When everyone around you is making money, your brain tells you it must be safe to join. That's herd behavior disguised as opportunity. You see a green candle, your neighbor is bragging about his gains, and suddenly you're no longer evaluating a trade. You're following a script written by history. Here's the pattern. First, a new story captures imagination. It could be the promise of the internet, the can't-fail American housing market, or the supposedly unstoppable rise of artificial intelligence stocks. The story spreads, attracting new participants. Prices rise, validating the story. More money flows in, driving prices even higher. A feedback loop takes hold. Eventually, valuations become detached from reality, but by then the mania is self-sustaining. You've probably seen it. A coin with no utility skyrockets, or a stock with no profits becomes the future. The media amplifies the hype, and you feel like a fool if you don't buy in. That's not a market anymore. That's a bubble rehearsing its collapse. Now, why should you care? Because as a trader, you're not insulated from these forces. Even if you swear you're rational, the psychology of the crowd infiltrates your decision making. How many times have you ignored your trading plan after reading a headline that screamed record highs or once in a lifetime opportunity? Shiller's historical lens is a mirror. It shows you that your impulses are not unique. They're part of a timeless cycle of human overconfidence. Look at the housing bubble of the 2000s. For years, home prices kept climbing, and people believed the story that real estate always goes up. Banks handed out loans to anyone with a pulse. Investors packaged those loans into complex securities, betting that defaults would never overwhelm the system. And traders? They bought into the mania because everyone else was. But when the story collapsed, the world plunged into a financial crisis. What's the lesson? That every time you convince yourself prices can't go lower or must keep rising, you're repeating the mistakes of countless traders before you. Mark Douglas would warn you here. The market doesn't owe you consistency. It doesn't promise that what worked yesterday will work tomorrow. Yet bubbles seduce you into believing the rules have changed. Jared Tendler would call it entitlement bias, the belief that you deserve to profit because you were smart enough to recognize the trend early. But when exuberance is driving the market, skill and luck become indistinguishable. You might profit, but you won't know why. And when you don't know why, you're set up for disaster. Here's the wake-up call. If you're not studying history, you're gambling blind. The stories change: railroads, dot-coms, crypto, housing, but the underlying psychology never does. Shiller shows you how the bubble blueprint repeats itself, and your job as a trader is to recognize when you're standing in the middle of that pattern. The chart might look unique, but the emotions behind it are recycled from every bubble in history. So ask yourself, are you trading with awareness, or are you just the latest actor in an old play? Are you examining valuations, risks, and probabilities, or are you chasing the thrill of joining the crowd? Every time you ignore history, you surrender control. Every time you convince yourself this one is different, you step closer to disaster. The choice is yours. You can be the trader who studies bubbles, recognizes the signals, and steps aside before the collapse. Or you can be the one who rides the wave, laughs at the skeptics, and then watches your gains vanish when history reams again. Shiller doesn't write history as an academic exercise. He writes it as a warning you ignore at your peril. And here's the truth. You don't need to predict the exact top or bottom. You just need to know when exuberance has taken over, when stories are louder than fundamentals, and when valuations are detached from reality. Because if you don't, you're not trading. You're gambling in a casino where history is the house, and the house always wins. Have you ever noticed how the loudest voice in the market isn't always the analyst with the data, but the story that captures imagination? Shiller calls this the contagion of stories. And if you've ever been swept up in a narrative about the future of money or the next Amazon, then you know exactly how dangerous and seductive these stories can be. They don't just entertain, they infect. They spread from trader to trader, from news headline to social media post, until they become a collective conviction strong enough to move billions of dollars. Think about it. Why did so many traders rush into internet stocks in the late 1990s? It wasn't because they were all carefully reading earnings reports. It was because the story of a new economy was too powerful to resist. Everyone was saying the internet would change everything, and they weren't wrong. But the story took on a life of its own. Prices soared far ahead of reality because the narrative was contagious. You didn't want to miss out on the future, so you convinced yourself that any company with a .com in its name was destined to win. That wasn't analysis. It was storytelling, masquerading as certainty. This is where Shiller delivers a brutal insight. Markets are not just shaped by facts. They're shaped by the way facts are told. Narratives create feedback loops. A story catches on, drives prices up, and those rising prices make the story seem even more credible. It's the financial version of gossip. When enough people repeat it, it feels true, even when it's not. And in your trading, if you don't recognize when you're trading a story instead of a setup, you're setting yourself up to be part of the herd that gets slaughtered. Consider the housing bubble. The dominant story was housing prices never fall. That phrase became gospel. Banks repeated it, homeowners repeated it, CNBC repeated it. The narrative spread like a virus until even cautious traders believed they were missing out on a once-in-a-lifetime opportunity. But when the story collapsed, so did portfolios, balance sheets, and entire economies. Did the fundamentals change overnight? No, the story did. Now, ask yourself, how many of your trades are influenced not by your system, but by the stories floating around in your feed? This coin is the future of finance. This stock is the next Tesla. This sector can't lose. Those aren't setups, they're narratives designed to lure you into emotional decisions. And the worst part? The more times you hear them, the harder they are to resist. Mark Douglas warned traders about this trap. You start assigning meaning to random events, believing that external voices validate your trade. But the only validation you should trust is your plan. Jared Tendler would call it narrative bias. Your brain's tendency to make sense of chaos by weaving it into a story, even if that story is fiction. The media knows this, social platforms know this, and the market exploits this. You must know it too. Think back. Have you ever chased a breakout not because your system signaled it, but because everyone online was talking about it? That's the contagion at work. You weren't trading the chart, you were trading the story. And if you're honest, you'll admit those trades rarely end the way you fantasize. Stories get you in late, keep you holding too long, and blind you to risk. By the time the narrative cracks, you're trapped, hoping instead of executing. Here's the wake-up call. Stories are fuel for bubbles. They don't just explain bubbles after the fact, they create them in real time. When enough traders believe the narrative, it becomes self-fulfilling. Until it doesn't. That's when the music stops, and the contagion spreads in reverse. Panic, fear, disbelief. The story collapses, and so do accounts built on it. But here's your edge: awareness. When you can spot the difference between a solid setup and a viral story, you give yourself an advantage over the herd. Instead of asking, "Is this story exciting?" you ask, "Is this story driving irrational behavior?" If the answer is yes, you either step aside or position yourself for the fallout. Because as Shiller makes clear, narratives don't just move markets, they trap traders who mistake belief for evidence. Steve Cohen constantly reminded his traders to journal their reasoning. Why? Because when you write down your trade logic, you expose whether you're following your system or following a story. If your notes say, "Everyone is buying this sector, I don't want to miss it," you've caught the contagion. But if your notes say, "This meets my criteria for entry based on risk reward," then you're trading, not gambling on gossip. Remember this: every bubble is built on a story that sounded reasonable at the time. The Dutch believed tulips were rare treasures. The 1920s crowd believed technology had erased risk. The 1990s believed the internet justified infinite valuations. The 2000s believed houses could never lose value. And today? Well, look around. You'll see the stories spreading. The question is whether you'll get infected or whether you'll stand apart, immune, disciplined, and prepared. Because in the end, the market isn't just a battle of numbers. It's a battle of stories. And the trader who wins is the one who knows when to ignore the noise and focus on the only narrative that matters, the one written in your plan, not in headlines. You've been there before. The moment you feel invincible. A few winning trades in a row, and suddenly you believe you've cracked the code. You start thinking you see things in the chart that others can't, that your instincts are sharper, that you have a special edge. This is overconfidence, and it's one of the most dangerous psychological traps in trading. Shiller dedicates a sharp spotlight to it, showing how entire markets, not just individuals, get caught in the illusion of invulnerability. Overconfidence isn't just arrogance, it's baked into your psychology. Behavioral finance studies reveal that the majority of traders consistently overestimate their skill, their timing, and their ability to control outcomes. Ask a room of traders if they're above average, and nearly all will raise their hand. Statistically, that's impossible. Yet in markets, this distorted self-perception is the norm. You want to believe you're better than randomness, and when luck aligns with your trades, you mistake it for proof of superiority. But Shiller takes this further. It's not just about your ego, it's about the herd. When enough traders become overconfident at the same time, the crowd reinforces itself. You look around and see others taking the same risks, so you feel validated. If everyone's doing it, it can't be that dangerous, you tell yourself. This is herd behavior, the belief that safety exists in numbers. But in markets, following the crowd is often the fastest way to disaster. Think about 2007, at the peak of the housing bubble. Homebuyers believed prices could never fall. Banks believed loans were safe. Investors believed mortgage-backed securities were rock solid. Everyone's confidence reinforced everyone else's. But that illusion of safety was a death trap. When reality hit, the herd stampeded in the other direction, and those who thought they were secure were wiped out. Now, bring this back to your trading. How many times have you sized up bigger than usual because your last trades were green? How many times have you ignored your stop loss because it can't possibly reverse here? That wasn't logic. That was overconfidence. And how often do you feel reassured when you see everyone on Twitter or Discord piling into the same trade? That isn't confirmation. That's herd behavior luring you into the same cliff. Mark Douglas warned that the greatest danger to traders is believing you can predict the market. His mantra was clear. Your job isn't prediction, it's risk management. Yet, overconfidence convinces you that you don't need to manage risk because you've got this. Jared Tendler describes it as an illusion of control bias, the brain tricking you into thinking your actions influence outcomes more than they actually do. That's why you double down after a win streak. That's why you ignore warning signs in pursuit of more profit. It feels like mastery, but it's really exposure to destruction. Have you ever noticed that the most dangerous words you can say as a trader are, "I know"? The moment you declare certainty, you blind yourself to risk. You stop preparing for alternatives. You ignore signals that contradict your view. That's not trading. That's gambling disguised as confidence. And when enough traders do this at once, you get bubbles. Herd behavior makes this worse. Humans are wired for belonging. You don't want to be the only one who misses out. So you follow. You mimic. You convince yourself that if everyone else is doing it, it must be smart. But in markets, the crowd is often late, emotional, and irrational. By the time the herd stampedes into an asset, the edge is gone. You're not early. You're the liquidity for the exit of smarter money. Shiller reminds you, the safety of numbers is an illusion. The market doesn't reward consensus. It punishes it. The moments when you feel most comfortable, most certain, are often the moments you're most at risk. Think of Bitcoin at $60,000, with every headline screaming new paradigm. Or meme stocks with armies of traders chanting to the moon. Confidence was everywhere. And then, collapse. The herd always looks powerful until it runs off a cliff. So how do you protect yourself? You cultivate humility. You remind yourself that no trade is guaranteed. No setup is certain. You journal your reasoning, not your feelings. You size based on risk, not on streaks. And most importantly, you develop the courage to go against the crowd when the crowd has lost touch with reality. Because the market doesn't care about your confidence. It only cares about discipline. Steve Cohen once told his traders, "You're only as good as your last risk management decision." That's the antidote to overconfidence. Not whether you were right, not whether you caught the move, but whether you protected yourself when you were wrong. Because eventually, you will be wrong. And if you've let overconfidence inflate your risk, that one mistake can erase months of progress. Here's the truth Shiller hammers home. Markets aren't destroyed by bad math. They're destroyed by human overconfidence, amplified through herd behavior. If you want to survive, you must learn to recognize when your certainty is lying to you, and when the crowd's comfort is a trap. The moment you feel invincible is the moment you're most vulnerable. And if you ignore that, you won't just lose trades. You'll become another casualty in the endless cycle of bubbles and crashes. So ask yourself, are you the disciplined trader who questions your own conviction? Or are you just another overconfident voice in the herd, waiting for history to humble you? Have you ever stared at a chart, calculated the valuation, and thought, there's no way this price makes sense, only to watch it keep climbing higher? That's the brutal conflict Robert Shiller wants you to see. Markets often detach from rational valuations because emotions overwhelm fundamentals. You can measure earnings, dividends, or cash flow, but you can't quantify greed, fear, or hope with the same precision. Yet it's those emotions that push prices far above or below what any metric can justify. Shiller introduced one of the most famous tools for valuation, the CAPE ratio, or cyclically adjusted price to earnings. It smooths out earnings over a decade to give a truer sense of how expensive or cheap the market is. Time and again, this ratio has shown when stocks are dangerously overvalued. In 1929, the CAPE ratio screamed warning. In 2000, during the dot-com bubble, it screamed even louder, and yet traders ignored it, preferring the story of a new era. That's the point. Fundamentals can shout, but when emotions run high, traders plug their ears. Why? Because emotions feel more real in the moment than numbers do. Numbers are abstract, slow, and boring. Emotions are immediate, vivid, and intoxicating. When you see a green candle ripping upward, your brain doesn't calculate earnings multiples. It screams, "Don't miss out." That's why fundamentals lose to emotions in the short term. You're not fighting the market, you're fighting your own wiring. This is where Mark Douglas's voice echoes loudly. Trading is not about being right, it's about managing risk. But when emotions take over, you convince yourself that fundamentals don't matter anymore. You start saying things like, valuations don't apply in this new economy, or it's different this time. Those phrases are red flags, signals that exuberance is replacing rationality. The CAPE ratio isn't wrong. You are, because you've allowed emotion to override discipline. Look at housing in the 2000s. Price-to-rent ratios and affordability metrics showed the market was overheated. But emotions told a different story. Owning a house was the American dream, and prices would only rise. People didn't want to hear about debt loads or income ratios. They wanted to believe, and so the bubble grew. Shiller's insight is harsh but liberating. Fundamentals matter, but they only reassert themselves when emotions exhaust. The crash is the moment when reality catches up, punishing those who ignored the warnings. Now, apply this to your trading. How often do you ignore your stop loss because the fundamentals look good? Or enter late into a rally because everyone says it's going higher? That's you choosing emotions over valuations. You're not being rational. You're rationalizing. Jared Tendler would call this a justification bias. Your mind-bending evidence to support the emotional decision you've already made. You think you're analyzing, but really, you're just finding excuses. Here's the truth. Valuations are like gravity. They don't matter on a rocket launch, but eventually they pull everything back to Earth. The longer you ignore them, the harsher the return. That's why discipline means respecting fundamentals even when emotions scream otherwise. You don't need to predict when the crash will come. You only need to respect that it will. But don't confuse this with paralysis. Fundamentals don't stop you from trading momentum. They help you frame risk. If you know valuations are stretched, you size smaller, tighten stops, or trade shorter time frames. You adapt. What you don't do is convince yourself that fundamentals no longer apply, because that's the moment you step from trading into gambling. Steve Cohen's traders knew this well. Trade the tape, but respect the context. The tape might show you momentum, but the context, the valuations, tell you how fragile that momentum is. When you ignore the context, you're blind to the bigger forces at play. And Shiller is clear, those forces always win in the end. So ask yourself, are you respecting valuations, or are you seduced by emotions? Do you check the CAPE, PE ratios, debt levels, or affordability metrics? Or do you only check the size of the latest green candle? Because the difference between a disciplined trader and a gambler isn't just their entries, it's their ability to anchor themselves in reality while everyone else floats away in euphoria. The market will always tempt you with stories. It will whisper, this stock is different, this sector is unstoppable, this coin will change the world. And maybe the stories have truth in them, but stories without discipline are how bubbles are born. Your job isn't to kill emotion, it's to filter it, to use fundamentals as your compass while others are lost in the fog. Because in the end, Shiller's message is this: prices may soar beyond reason, but reason always returns. And when it does, the traders who ignored fundamentals are left asking, how could this happen? Don't be one of them. Respect the numbers, respect the risk, and let discipline anchor you when emotions try to sweep you away. Have you ever wondered why a market that's already expensive keeps getting more expensive? Why traders keep piling into something that should already be overpriced? Shiller explains this with the brutal clarity of feedback loops. Markets don't just move, they amplify. A rise in prices doesn't just reward early participants, it seduces new ones. Those new participants push prices even higher, which in turn validates the original belief. And the cycle repeats until reality finally snaps the chain. Think about it. You see a stock breakout, volume surges, and early buyers are rewarded instantly. Their success becomes visible, shared, and bragged about. That visibility is contagious. More traders rush in, not because they've analyzed fundamentals, but because they've seen others profit. Prices climb again, and suddenly the narrative shifts from risky trade to safe opportunity. The loop strengthens itself. It's not rational, it's reflexive. This is the essence of what Shiller calls market amplification. Positive feedback loops drive bubbles. Negative feedback loops drive crashes. Both are fueled by psychology. When prices rise, optimism reinforces buying. When prices fall, pessimism reinforces selling. You've seen it, panic selling during a sharp drop, each trader dumping because they see others dumping. That's not analysis, it's a chain reaction. George Soros described this as reflexivity, the idea that traders' perceptions can alter fundamentals, not just reflect them. Shiller builds on this, showing how these self-reinforcing cycles create unsustainable momentum. You think you're trading a chart, but in reality, you're caught in a loop of human behavior. Now, here's the trap for you as a trader. Feedback loops feel like evidence. When you see prices rising day after day, it feels like proof that your belief is correct. But it's not proof. It's just the loop feeding itself. That's why bubbles always look logical in the moment. Rising prices confirm the story, and the story fuels more rising prices. It's a perfect circle, until it isn't. Mark Douglas would warn you here. The market doesn't reward you for being right. It rewards you for managing probabilities. But when you're caught in a feedback loop, you abandon probabilities. You believe certainty has arrived. You think, if it keeps going up, I can't lose. That's when you stop managing risk and start gambling. Jared Tendler would call this an illusion of stability. You trick yourself into thinking the loop can't break. But every loop breaks. Consider Bitcoin's surge to nearly $20,000 in 2017. Each new high validated the story. Digital gold, unstoppable, to the moon. The loop was intoxicating. New buyers entered daily, media coverage exploded, and skeptics were mocked. But when the loop reversed, the same mechanics amplified the fall. Sellers triggered more sellers, fear fed fear, and within a year, Bitcoin crashed by 80%. The loop giveth, and the loop taketh away. Now, apply this to your trading. How often have you chased a move because it just keeps going? That's you being seduced by a feedback loop. How often have you sold in panic because it just keeps dropping? That's you trapped in the reverse loop. You weren't trading, you were reacting. You were a cog in the machine of amplification, not the one steering your own risk. Steve Cohen's advice to his traders was blunt. Don't chase. Why? Because chasing means you're already late in the loop. By the time you see it, the early money is positioned and you're just adding fuel to their profits. Your edge isn't in joining the loop, it's in anticipating when the loop has stretched too far. That's how professionals survive while amateurs get burned. So how do you guard against the seduction of feedback loops? By detaching from the crowd's narrative and anchoring yourself to process. That means asking, what is my entry? What is my exit? What is my risk? If you can't answer those, you're not trading, you're amplifying. And the market doesn't pay amplifiers in the long run. Remember this, the strongest rallies and the deepest crashes aren't signs of certainty, they're signs of distortion. The faster and steeper the move, the more likely it's being driven by a feedback loop, not fundamentals. And if you can see that, you don't have to be the one caught when the loop reverses. Shiller's insight is simple but unforgiving. Bubbles don't burst because of one event. They burst because feedback loops reach a breaking point. Your job isn't to predict the exact tick of reversal. Your job is to recognize when the loop is unsustainable and protect yourself before the crowd realizes it. So next time you feel the urge to chase a parabolic move, stop. Ask yourself, am I trading my plan? Or am I caught in the loop? Because the difference determines whether you're the trader cashing out before the collapse or the one left holding the bag when the music stops. What happens when the music stops? When the euphoria that once made you feel unstoppable flips into panic that paralyzes you? Shiller calls this the collapse of exuberance, and if you've ever held a position through a crash, you know exactly how it feels. The same psychology that fuels manias drives the devastation of sell-offs, only in reverse. Optimism becomes denial, denial turns to fear, and fear mutates into despair. Suddenly, the chart that once made you feel rich now makes you feel sick. Think of October 1929. Stocks had been soaring for years, fueled by leverage and the belief that prosperity was permanent. But once the cracks appeared, the feedback loop flipped. Selling triggered more selling. Leveraged traders were forced to liquidate, and the crowd that had once roared with confidence collapsed into silence. The same herd that pushed prices skyward now stampeded downward. It wasn't rational. It was reflexive. And here's the truth. You've lived a version of this on your own account. Remember the time you ignored your stop loss because it will bounce? At first, you felt denial. Then the loss grew, and you felt fear. Eventually, you froze, unwilling to take the hit, until finally the market forced it on you. That's the collapse of exuberance at a micro scale. What you felt in your small account is what markets feel collectively during crashes. Shiller maps this psychology with precision. The phases of collapse are predictable. Denial. Traders insist it's a dip, not a reversal. Anxiety. Losses mount, but hope lingers. Capitulation. Panic selling. Forced liquidations. Headlines of doom. Despair. Markets overshoot to the downside as optimism disappears. Sound familiar? It should, because this pattern repeats in every major crash. The dot-com bust, the 2008 financial crisis, the COVID-19 meltdown in March 2020, they all followed this rhythm. And here's the terrifying part. In the moment, it never feels obvious. You don't recognize capitulation until after it's over. While you're in it, you're just reacting to pain. Mark Douglas warned you, trading isn't about avoiding losses, it's about managing them. But when exuberance collapses, most traders forget this. They stop managing risk and start managing emotions. Instead of executing, they freeze, bargain, or panic. Jared Tendler would call this a complete tilt. Your mental game breaks, and you're no longer in control. The chart controls you. Now think about how professionals handle crashes. They don't try to call the exact top or bottom. They focus on survival. Steve Cohen reminded his traders constantly, live to play another day. That's the mindset that saves accounts when exuberance collapses. You don't need to be the hero who nails the exact reversal. You need to be the survivor who has capital when others don't. But here's where Shiller's insight cuts deeper. The collapse of exuberance doesn't just hurt financially, it scars you psychologically. After a major loss, you hesitate to re-enter. You second-guess valid setups. You become overly conservative, missing opportunities because you're haunted by past pain. That's despair. The market punishes you on the way down, and then it punishes you again by making you afraid to come back when conditions improve. So what do? First, you build awareness. You recognize that exuberance always collapses. It's not a matter of if, only when. Second, you respect your risk plan even when others abandon theirs. Your stop loss isn't a suggestion, it's your lifeline. Third, you accept that your job isn't to escape crashes entirely, but to minimize their damage. You don't control the collapse, you control your exposure. Here's the hard question. Are you prepared for the next collapse? Not in theory, but in practice. Do you have a written plan for when volatility spikes, spreads widen, and liquidity evaporates? Or will you freeze, hoping the market shows mercy? Because the market never shows mercy. It will humble you, strip you, and expose every weakness in your discipline. And if you're not ready, it will erase you. Shiller's message is clear. Collapses are inevitable. They are not anomalies. They are features of markets driven by human psychology. The crowd always overshoots, both on the way up and the way down. Your survival depends on accepting this and preparing for it. If you can't, you'll join the millions of traders who once bragged during manias and now stay silent after crashes. So the next time you feel euphoric, remember this. Every bubble ends the same way. The crowd that cheers you now will abandon you later. The gains that feel permanent today can evaporate tomorrow. The only constant is risk, and the only question is whether you'll respect it before exuberance collapses or after it's already too late. What if I told you that bubbles don't just hurt traders? They tear through entire economies, leaving scars that last for decades. Shiller doesn't let you escape into the illusion that irrational exuberance is only about charts, trades, or individual accounts. He makes you face the devastating truth. When bubbles collapse, they drag down not just speculators, but workers, families, and entire nations. And if you ignore that broader impact, you're trading blind to the real consequences of financial mania. Take the housing bubble of the 2000s. At the peak, traders, homeowners, and bankers all believed the story. Housing prices never fall. But when reality shattered that illusion, the fallout wasn't just paper losses in portfolios. It was millions of foreclosures, bankruptcies, and layoffs. Families lost homes, retirement accounts were gutted, unemployment soared, and the economy spiraled into the worst recession since the Great Depression. What started as euphoria on trading desks became despair in living rooms across the world. Shiller's point is sobering. Markets are not isolated casinos. The waves of irrational exuberance ripple outward, turning financial errors into social disasters. The herd that buys into bubbles doesn't just inflate prices, it inflates debt, leverage, and risk across entire systems. And when the crash comes, ordinary people who never traded a single share pay the price. That's why your awareness as a trader matters. It's not just your account at stake, it's the broader stability of everything around you. Consider the dot-com bubble. At first, it looked like just another speculative frenzy, but when it burst, hundreds of thousands of workers lost their jobs as tech companies collapsed. Pension funds evaporated. The Nasdaq lost nearly 80% of its value. The excitement that had once promised a new economy instead delivered widespread disillusionment. Once again, exuberance didn't just destroy traders, it disrupted lives. This is why Shiller insists on understanding bubbles as social phenomena, not just financial events. Stories spread through media, workplaces, and communities. Narratives about easy wealth drive not only traders, but also everyday people to overextend themselves, taking loans, over-leveraging, chasing unsustainable opportunities. And when the tide turns, the pain is magnified far beyond the trading floor. Now, why should this matter to you as a trader? Because if you only think in terms of short-term profit, you'll miss the bigger forces shaping the very market you're trading. When a bubble grows large enough, policymakers intervene. Central banks change rates, governments pass regulations, institutions panic. The feedback loop Shiller describes doesn't stop at prices. It pulls the entire economy into its spiral. And if you're not aware of this, you'll be blindsided by sudden volatility that isn't just technical, but systemic. Mark Douglas told you, the market is an environment of endless uncertainty. Shiller adds, that uncertainty doesn't stay confined. It leaks into everything. Jared Tendler would remind you that stress isn't just emotional, it's systemic. When the market melts down, liquidity vanishes, spreads widen, and even good strategies can fail because the system itself is cracking. If you think your trading is insulated from the broader economy, you're fooling yourself. Look at March 2020 during the COVID crash. That wasn't just a market correction. It was a global panic. Airlines collapsed, oil went negative, unemployment spiked overnight. The crash reminded traders that bubbles and shocks don't respect boundaries. They punish everyone, everywhere. And those who weren't prepared found themselves not only losing trades, but also losing jobs, savings, and confidence in the system itself. So here's your challenge. Are you trading with awareness of the bigger picture? Or are you trapped in the illusion that your screen is the whole world? Because if you fail to see the ripple effects, you'll underestimate both the risks and the opportunities. When bubbles collapse, volatility explodes. Fortunes are lost, but they are also made by those who understand that exuberance doesn't just create chaos, it creates windows for disciplined traders. Steve Cohen understood this well. During crises, he pushed his traders to stay calm, stay liquid, and look for mispricings caused by panic. While the herd was drowning, disciplined professionals were finding value. That's the paradox of collapse. For the undisciplined, it's destruction. For the prepared, it's opportunity. But you can't seize it if you're emotionally wrecked or blindsided by the scale of the fallout. Shiller's lesson here is blunt. Irrational exuberance is not harmless optimism. It's a social disease. It infects markets, spreads through economies, and punishes societies. As a trader, you don't have the luxury of ignoring that. You must respect how fragile systems are, how quickly optimism turns to despair, and how much pain can be caused when you let yourself be swept into the mania. So the next time you feel tempted to dismiss a bubble as just speculation, remember this. Those green candles can burn down more than portfolios. They can collapse economies. They can destroy livelihoods. And if you don't take that seriously, you'll be part of the problem instead of the solution. Your job isn't just to trade, it's to trade with awareness. To recognize that the consequences of irrational exuberance reach far beyond you, and that your discipline isn't just about profit. It's about survival in a system that punishes the reckless and rewards the prepared. How do you resist mania when the whole world is screaming at you to join it? How do you hold discipline when your friends, your social feeds, and even respected institutions insist you're missing the chance of a lifetime? Shiller doesn't just describe bubbles, he arms you with the mindset to resist them. And if you've ever felt the itch of FOMO, you know how badly you need that armor. The first step is awareness. You can't fight what you can't see. You need to recognize the red flags of exuberance. Media headlines that sound like hype rather than analysis. New era language that claims old rules don't apply. Valuations stretched far beyond historical ranges. And crowds insisting you're a fool if you don't join in. Every bubble carries these signals. The question is whether you'll notice them or whether you'll be seduced by them. Mark Douglas taught that discipline begins with probabilities. Your job isn't to join the crowd, it's to evaluate setups with a clear head. When exuberance builds, probabilities shift against you. Sure, momentum might keep running, but risk explodes. And if you're not adjusting your behavior, you're not trading, you're gambling alongside the herd. Shiller warns you, the mania always feels safest right before the collapse. That's when resisting is hardest. Everyone looks like a genius. Paper fortunes multiply overnight, and you feel like the only one sitting out. But that loneliness is your edge. Jared Tendler would call it emotional control, the ability to feel the sting of exclusion without letting it hijack your decisions. Because if you can't stand missing out, you'll keep buying tops and selling bottoms. So how do you resist? By building structures stronger than emotion. Journaling isn't busy work, it's a mirror. Write down why you're entering a trade. If your reasoning starts with because everyone's buying, you've already lost. A proper entry should be tied to your system, your risk parameters, and your edge, not to the crowd's excitement. Journals expose whether you're thinking clearly or just chasing noise. Another weapon is preparation. Before the mania even arrives, decide how you'll respond. Steve Cohen drilled this into his traders. Don't wait until you're emotional to decide. Decide in advance. That means defining your max risk, your exit triggers, and your criteria for sitting out. When the storm comes, you don't improvise. You execute. But resisting mania isn't just about defense. It's also about offense. Contrarian thinking, when applied with discipline, can be powerful. If you recognize that exuberance has driven prices far beyond reality, you can position yourself for the reversal. That doesn't mean recklessly shorting every rally. It means waiting for confirmation, then exploiting the crowd's blindness. The herd always overshoots, and their collapse always leaves opportunity for traders who kept their powder dry. The hardest part, though, is mastering your own mind. FOMO is real. Social proof is powerful. Watching others get rich while you stay cautious feels unbearable. But Shiller reminds you, the market doesn't reward comfort, it rewards discipline. Comfort is found in crowds. Discipline is found in solitude. You need the courage to look foolish today in order to avoid ruin tomorrow. Ask yourself, how many times have you broken your rules because you didn't want to be left behind? How many times have you watched the chart reverse right after you chased it? That's the cost of surrendering to mania. And every time you do it, you strengthen the habit of self-betrayal. The only way to break that habit is to prove to yourself, again and again, that discipline protects you more than FOMO ever could. Mark Douglas said it best, the consistency you seek is in your mind, not in the markets. That means resisting mania isn't about predicting the crash. It's about controlling yourself while the crowd loses control. Your edge is not knowing the future. It's knowing yourself. So the next time you feel the itch to join the madness, pause. Ask yourself, am I trading my plan or am I trading my fear of missing out? If it's the latter, step back, because the mania will end, the crowd will suffer, and the disciplined trader will still be standing, ready to capitalize when clarity returns. Resisting mania doesn't mean never participating in strong trends. It means knowing the difference between disciplined momentum trading and reckless bubble chasing. One is controlled risk. The other is emotional surrender. And if you want to survive long enough to thrive, you must choose control every time. Shiller's message is simple, but uncompromising. Resisting exuberance isn't just smart, it's essential. Without resistance, you'll eventually give back everything you gain. With resistance, you'll not only survive bubbles, you'll be positioned to exploit them. The crowd will always scream. The stories will always tempt. But your survival depends on one question. Will you have the courage to resist when it matters most?